There's something strange happening in markets right now. And for once, it's not Nvidia. It's not another AI company raising money at a valuation that looks like someone accidentally leaned on the zero key. It's not even the Federal Reserve, although if you give financial media enough time, somehow every story eventually becomes about Jerome Powell's facial expressions. The strange thing is gold, which already sounds ridiculous because gold is supposed to be one of the most boring assets on Earth. It pays no interest, produces no earnings, launches no product updates, and has no management team promising to integrate AI across the platform, just to keep investors calm. Gold's entire business model is sitting still, and for a long time, that made it easy to dismiss. People treated it like the asset you bought when inflation felt uncomfortable, when the dollar looked shaky, or when your uncle spent too much time online and started explaining why society would collapse before the next Costco run. But recently, gold has been harder to laugh off. It keeps going up. The simple explanation is inflation. Prices rose, people got nervous, and gold did what gold usually does when confidence slips. That explanation is partly right. It is also far too small. Gold is moving like something deeper in the financial system has changed. The interesting part is not just the price, it is the environment around the price. Rates are still elevated. Cash actually pays something again. Treasury bills exist. Money market funds exist. For the first time in years, investors can earn a respectable return by doing almost nothing, which should make life difficult for an asset famous for doing even less. And yet buyers keep showing up, not only retail investors, not only the doomsday crowd. Central banks, governments, and large institutions are treating gold less like a relic and more like insurance. Once that happens, the story stops being about shiny rocks and starts being about trust. That is what gold really measures. Gold is a trust thermometer. Modern finance runs on promises. A treasury bond depends on the U.S. government paying you back. A bank deposit depends on the bank staying solvent. A corporate bond depends on a company producing enough cash to meet its obligations. Even money itself depends on the shared belief that someone else will accept it tomorrow. Most of the time, this works so smoothly that nobody thinks about it. Payments clear, bonds trade, dollars move, brokerage accounts update. The plumbing does its job quietly in the background, and everyone gets to pretend the system is simpler than it really is. But when the promises get more complicated, an asset with no issuer starts to look different. Gold does not rely on a company's cash flow, a bank's balance sheet, or a government's willingness to honor a specific obligation. It sits outside the normal chain of financial claims. In a world built almost entirely on claims against someone else, that makes it strange. And sometimes strange becomes useful. For decades, the safest promise in the world was the U.S. Treasury bond. When markets panicked, money ran into treasuries. When countries needed reserves, they held treasuries. When banks needed collateral, treasuries were the cleanest answer. They became the financial system's fire extinguisher. Whenever something caught fire, investors reached for them. That belief has not vanished. This is not a dollar collapse rant where someone puts flames over the White House in the thumbnail and tells you to buy canned beans before midnight. The dollar is still dominant. Treasuries are still central to global finance. The United States still issues the world's most important reserve currency. But dominance and invincibility are not the same thing. Markets are starting to price a world where the system still works, but with more friction than before. More debt, more volatility, more political risk, more questions around what safe actually means. Start with the debt. The United States has to keep issuing enormous amounts of treasuries because the government keeps running enormous deficits. That alone does not create an immediate crisis. Countries can run deficits for a long time, and the U.S. has advantages most countries would love to have, especially the ability to borrow in its own currency. Still, every deficit eventually becomes new issuance. Every new bond needs a buyer, and when the pile gets large enough, buyers begin asking for more compensation. That compensation shows up as higher yields. Higher yields then create their own feedback loop. The government spends more on interest, which makes the deficit larger, which requires more borrowing, which leaves the market absorbing even more supply. The math does not explode overnight, it just gets heavier. That kind of heaviness is exactly the environment where gold starts to make sense. Not because gold fixes the debt problem, it obviously does not, but because it sits outside the debt problem. A treasury bond carries duration risk, reinvestment risk, political risk, fiscal risk, and price risk. It may still be extremely safe from default, but safety from default is not the same thing as freedom from consequences. Gold has its own flaws. It can be volatile. It can go nowhere for years. It can make its holders look brilliant in one cycle and tiresome at dinner in the next. But it does not need to be refinanced. Its cost does not rise when yields rise. There is no maturity wall, no interest expense, no awkward investor presentation explaining why the numbers would look great if you adjusted out reality. It just sits there, quietly judging everyone else's balance sheet. This is where the old gold framework starts to feel incomplete. Analysts usually look at gold through real yields. If inflation-adjusted yields rise, gold should struggle because investors can earn a real return in safe bonds. That relationship still matters. It has not disappeared, but it no longer explains everything. Because what happens when the safe bond still pays you, but the fiscal situation behind it looks more stretched? What happens when the bond is liquid, but its price swings more violently? What happens when the asset is safe from default, but exposed to inflation, politics, sanctions, and supply pressure? At that point, the market is not only asking, what yield can I earn? It is asking, what do I trust? That question matters even more for central banks. A normal investor can chase returns. A reserve manager cannot think like someone trying to beat the S&P 500 so they can post a screenshot and call themselves a macro genius. The job is survival. A country's reserves need to work when things go wrong. They need to be liquid in a crisis, credible in a panic, and available when the country actually needs them. That last part has become much more important. Foreign reserves are not just money sitting in a cartoon vault. Many of them are financial claims inside another country's system. They move through custodians, banks, payment networks, legal systems, and political relationships. This arrangement works beautifully until access becomes conditional. Over the last few years, countries watched reserves get frozen. They watched payment systems become geopolitical tools. They watched the financial system prove that money is not always just money. Sometimes money is also permission. You can argue those policies were justified. You can argue they were necessary. That is a separate conversation. The market structure point is simpler. Once reserves can be frozen, every central bank has to update the risk model. Assets held inside someone else's system come with someone else's politics. That does not make them useless. It makes them less neutral than they used to feel. Physical gold held directly occupies a different category. It has no issuer, no payment rail, no central bank behind it, and no correspondent bank deciding whether a transfer clears. Nobody can sanction a bar of gold with a customer service email. That is why central bank buying matters. It is not just a trade, it is a message. Central banks are not declaring the dollar dead. They are not saying treasuries are worthless. They are not moving into bunkers with hand crank radios. They are saying concentration risk has gone up. For a long time, dollars and treasuries were the obvious answer. Liquid, deep, accepted, and useful. They still are. But more countries are asking whether they want so much of their national savings tied to one currency, one legal system, and one geopolitical framework. That is not de-dollarization in the dramatic internet sense. It is diversification in the boring reserve manager sense. And when enough boring decisions happen at the same time, markets move. This is why the gold move feels different. Panic trades usually spike, fade, and wait for the next crisis. This looks more structural. The buyers move slowly. The reasons are tied to debt, reserves, sanctions, currency concentration, and confidence. That kind of demand does not disappear just because one inflation print comes in slightly cooler than expected. There is another piece people forget. Bonds have not felt as safe as they used to. The issue is not whether the US is about to miss a payment. That is not the point. The issue is price. If you owned long-duration government bonds before rates surged, you learned a painful lesson. A bond can be safe from default and still lose a lot of market value. That broke a lot of assumptions. For years, investors treated bonds as the calm part of the portfolio. Stocks brought the drama. Bonds were where money went to relax, collect a coupon, and avoid eye contact. Then, rates surged, and the calm part of the portfolio started acting like it had discovered energy drinks. When the safe side becomes volatile, investors look for a different kind of safety. Gold benefits from that shift. It is not a perfect hedge. It does not protect against everything. It does not move cleanly every time something bad happens. But it behaves differently from stocks, bonds, and currencies. In portfolio construction, different can become valuable. Especially in a world where stocks are expensive, bonds are volatile, deficits are large, and currencies are increasingly tied to geopolitics. That is the real story. Gold is rising because the assets around it are being questioned in new ways. The dollar remains powerful, but dependency on the dollar is being repriced. Treasuries remain safe, but safety no longer feels simple. Central banks still need reserves, but reserves now carry access risk. Governments can still borrow, but borrowing comes with a higher interest bill. Investors still want protection, but the old toolkit feels less automatic than it did when rates were pinned near zero, and everyone assumed liquidity would always show up. Gold is useful because it turns all of that into one signal, not a prediction that the world is ending, not a guarantee that the metal only moves higher, not an instruction to sell your portfolio and start burying coins behind a chipotle. A signal. Trust is being repriced, and trust usually changes slowly before it changes suddenly. People notice small things first. Deficits stop looking temporary. Interest expense becomes harder to ignore. Long-term bonds stop behaving like the old safe haven. Central banks buy more gold. Countries experiment with new settlement systems. Reserves start looking less like neutral assets and more like geopolitical instruments. Individually, none of those things breaks the system. Together, they change the price of trust. Gold is one of the cleanest ways that price shows up. That is why the inflation hedge explanation misses the bigger picture. Inflation is part of the story, but if inflation were the whole story, gold would be much easier to explain. You could pull up one chart, point to consumer prices, and go home early. Markets are rarely that generous. The better explanation is that gold is responding to a world where the old hierarchy of safe assets is becoming messier. Treasuries still matter, the dollar still matters, central banks still hold both, but the unquestioned dominance of those assets is being hedged at the margin, and marginal changes are how big systems move. No central bank needs to dump all its treasuries for this to matter. No country needs to abandon the dollar. No investor needs to become a gold bug. Enough buyers only need to decide they want slightly more of the asset that sits outside everyone else's promise. That is the trade. Trust. When trust is abundant, gold looks useless. Productive assets make money, bonds pay interest, cash earns yield. Gold sits there doing nothing and looking outdated. But when trust gets more expensive, sitting outside the system becomes valuable. The uselessness becomes the point. Gold does not adapt, issue debt, promise growth, or need a central bank pivot to make the math work. It simply remains outside the structure everyone else depends on. In a financial system built on promises, that can be enough. So the real reason gold keeps going up is not that investors suddenly rediscovered a 5,000-year-old metal. The world around that metal changed. Debt got heavier, bonds got more volatile, reserves got more political, currencies got more complicated. The old assumption that the safest assets would always feel safe became less automatic. That does not mean the dollar is finished. It does not mean treasuries are broken. It does not mean gold is perfect. It means the financial system is quietly putting a higher price on trust. And if you want to understand markets before the headline becomes obvious, this is the kind of signal worth paying attention to. Not because it tells you exactly what happens next, but because it shows what investors and central banks are starting to worry about. Gold is not the fire. It is the smoke alarm. And right now, the smoke alarm is getting harder to ignore. So if you want more breakdowns of the market stories hiding underneath the headlines, subscribe. Because the biggest shifts in finance usually do not start with a crash. They start with a boring asset doing something weird while everyone else is distracted by the loudest story in the room. And right now, while everyone is watching AI, rate cuts, and whatever the stock market did this week, gold is quietly telling a different story. The metal is not the point. The trust behind it is.